Welcome to Echo 371, Study Session 6, Taxation, Introduction. In this session, you shall be exposed to what tax is and why it is collected. We will also examine principles and types of taxation, learning outcomes. After you have studied this session, you should be able to 1. Explain the meaning of taxation. 2. Explain the objective of taxation. 3. Discuss the characteristics of taxation. 4. Differentiate between direct and indirect taxes. 5. Discuss the principles of a good tax system. 6. Distinguish between the impact of a tax and the incidence of a tax. 7. Criticize between tax evasion and tax avoidance. A tax is a compulsory levy imposed on individuals, corporate bodies, goods and services. H.L. Barrier 2006 defines tax as compulsory levy payable by an economic unit to the government without any corresponding entitlement to receive a definite and direct quid pro quo from the government. Therefore, it means that any benefit received by taxpayers from the government are not related to or based upon their being a taxpayer. Tax is a source of revenue to the government. In addition to this, government may raise or lower taxes to achieve social and economic objectives or to achieve political popularity with certain groups. Taxation can redistribute a society's wealth by imposing a heavier tax burden on one group in order to fund services for another. Also, some economists consider taxation as an important tool for maintaining the stability of a country's economy. Objective of taxation. There are many reasons why government imposes tax on persons, corporate bodies, or on goods and services. Number 1, revenue generation. Tax serves as one of the main sources of revenue to the government. Governments use money generated from tax to provide funds for economic activities such as social infrastructure to the people, maintenance of law and order, etc. 2. To discourage consumption of certain or harmful commodities. Government uses tax to discourage the consumption of certain commodities by imposing high taxes on such goods, which will make them to be expensive, and those buying them will have to spend larger proportion of their income to get them. Hence, this discourages many people from consuming such commodities. 3. To correct balance of payment deficit. When income received from exports is less than expenditure on imports, government could impose high tariff or taxes on unnecessary imports, which will reduce the importation and encourage import substitution, which will correct balance of payment deficit and lead to the growth and development of the economy. 4. To remove poverty and inequality. Progressive tax system may be adopted in any economy to bridge the gap between the rich and the poor. This is a system where tax paid by a taxpayer increases as the income increases. The money realized from this tax is used to improve the welfare and living conditions of the people. 5. To guide or control economic activities. Government uses tax to guide, control, or correct economic activities towards the desired line. For example, When there is inflation in the economy, tax rate can be increased to reduce aggregate demand, hence reduce inflation. On the other hand, when there is economic slump, government can reduce tax rate to boost aggregate demand, which will lead to increase in purchase of goods and services. Characteristics of taxation. For achieving certain objectives, a good tax system must possess some characteristics. These are: 1. Equality. This means that the good tax system should be fair and based on the individual's ability to pay. The high income earners should be taxed more than low income earners. That is, each individual pays according to the proportion of his ability. 2. Certainty. A good tax system should be certain and clear in terms of percentage or proportion, time, method, and amount of payment. All these must be known to the taxpayer and tax collector. Payment of tax should be based on existing laws and regulations. A tax collector should not use his discretion to determine how much to be paid as tax. 3. Convenience. A good tax system should be convenient to the taxpayer as to when to pay, how to pay, and the method of payment. For instance, a salary earner should be taxed when he receives his salary through the system of payee, pay as you earn. Number 4. Economy. The cost incurred in collecting tax, that is, payment of salaries to logistics personnel and others, should not be more than the total tax revenue collected. 5. Simplicity. Tax should be simple to calculate, administer, and understand. Tax laws and obligations should not be complicated to interpret. 6. Buoyancy. The amount that is collected as tax should increase with time, as there is significant evidence that there is increase in national income of the country. Forms of tax. Having learned from the previous section, in this session that taxation is one of the main sources of government revenue, this session will expose you to the different types of taxes with their advantages and disadvantages. Direct tax. This is a tax whose burden falls directly on the person or thing taxed and cannot be shifted to another person or thing. It is a tax imposed on income, wealth, and property. Examples are types of direct tax. Personal income tax. It is a tax levied on the gross income of individuals, but all the allowances and other deductions are effected before the remaining gross income is taxed. Personal income has potential of increasing government revenue and can be used to redistribute income among people. It conforms widely with the acceptable standard of equity. Income consists of all economic gain that an individual has attained during the tax period, but there is a problem of how to take care of non-monetary transactions, e.g., free medical care, free transport, and free accommodation. Such income does not include monetary transaction. In other words, personal income tax does not take care of those that do not enter into economic transactions. Company income tax. This is a tax levied on the profit or net income of companies. Capital tax. This is a tax imposed on capital assets, properties, and assets whose value appreciates, such as land, building, or machinery. Tax on the property is only on real property such as land, building, or machinery. As mentioned above, personal property such as furniture, vehicles, or jewelry are excluded from taxation. Petroleum profit tax. This is a tax paid for the petroleum exploration and exploitation of the mineral resources on land. Advantages of direct tax. A. Direct tax adopts ability to pay principal. Hence, there is equality in the burden of tax among the different taxpayers. B. Direct tax is economical. The cost incurred in collecting direct tax is very small, especially income tax, when compared with indirect tax. C. Government can forestall the revenue range derivable from this source and enable it to budget for its activities. D. Direct tax is a fiscal policy instrument to curb inflationary pressures in the economy. When there is high inflation, government increases the tax in order to reduce aggregate demand or reduce taxes in order to increase aggregate demand during economic slump. F. Direct tax makes people to have direct contribution to the administration of the national economy. Disadvantages. A. The practice and possibility of tax evasion and tax avoidance is common in direct taxes than in cases of indirect taxes. Workers or companies do not reveal their true income so as to pay little amount of tax. B. High tax rate reduce the willingness to work on the part of taxpayers, and this is a bad one for the economy because it leads to the slowing down of economic growth. C. Direct taxes reduce profit margin of companies, making it impossible to embark on new projects. Hence, it discourages industrial activities. D. High tax rate reduces savings. When a certain amount of individual income has been removed of tax, this reduces the amount to be saved. Hence, capital accumulation in the economy will suffer and there will be retardation of economic growth. Indirect tax. This is a tax imposed on goods and services whose entire burden or part of it is shifted to the consumer of such goods and services through higher prices. Indirect tax is a better source of revenue to the government because people pay them unknowingly and they cannot evade it. The degree at which the burden is passed to the consumer depends on the elasticity of demand of the commodity being taxed. Examples of indirect taxes are: 1. Excise tax duties. This is a tax imposed on the goods that are produced within the country, such as cement companies, textile industries, etc. The total tax generated through excise tax depends on the level of industrialization of the country. In Nigeria, the amount generated is low due to the import substitution strategy policy of the government. Value added tax. In Nigeria, VAT, that is value added tax, was introduced in 1994 by the Abacha regime. The value added tax replaced the sales tax formerly administered by the federal government and shared among the three tiers of government. It is a buoyant tax and also represents the most significant part of non-oil revenue. It is a tax on goods and services levied at each stage of production and distribution. It has the potential to raise the prices of goods and services in the economy. Export duties. It is a tax levied on goods exported out of the country. Governments use export duty to encourage exportation by reducing the export duty rate to enhance more foreign earning. In Nigeria, the importance of this revenue came into significance in the early 1990s during the oil boom. The export duty was abolished in 1987. It has been argued that this form of taxation is not equitable because it amounts to double taxation. Import duty. It is a tax imposed on goods imported into the country. It is a good source of revenue to the government. It can be used to protect domestic industries from foreign competition by making import items more costly. Advantages of indirect tax. A. Indirect tax is convenient. The amount of tax paid by the taxpayer is hidden in the prices of the goods and services, so the effect is not felt more. Also, the taxpayer pays the tax in bits and only when he or she buys or sells such goods. B. With proper administration, the cases of tax evasion and avoidance are limited, since payment of tax is made at every point of purchase. For example, excise duties are difficult to evade if the government machinery is vigilant and there is proper check at the point of production. C. It is a powerful tool in controlling the production and investment activities of the economy. Indirect tax can guide the economy in its resources allocation by encouraging higher priority industries and discouraging lower priority ones. For example, government can impose a high rate of excise duty to raise the price of certain goods and discourage its demand. Reduced profitability of these goods will lead to the drying up of investment on such lines and diverting it to those lines where profitability is comparatively higher. D. It is a selective policy tool. The rate of indirect taxes and their coverage can be selective and modified to suit the economic situation. E. Indirect taxes help towards increasing employment or encouraging the adoption of a given type of technology. For example, the government can impose low excise duty rate on labor-intensive output and high excise duty rate on capital-intensive output. This will encourage companies to adopt labor-intensive methods of production, thereby increasing the level of employment. Disadvantages. A. Indirect taxes tend to generate inflationary measures in the economy. It adds to the cost of production, which generates higher prices of goods and services. B. Indirect taxes neglect the principle of ability to pay, and the poor are worse off by paying more since the payment of tax is spread evenly. Principles of tax. 1. Fairness principle. Economists consider two principles of fairness to determine whether the burden of a tax is distributed fairly. A. Ability to pay principle. This holds that people's taxes should be based upon their ability to pay. There are two requirements of the ability to pay principle. 1. Horizontal equity. This states that people in equal position earning the same income should pay the same amount of tax. There are two requirements of the ability to pay principle. 1. Horizontal equity. This states that people in equal position earning the same income should pay the same amount of tax. E.g., if two people both have incomes of 50,000 each, then horizontal equity requires that they should pay the same amount of tax. 2. Vertical equity. This requires that the tax system should distribute the burden fairly across people with different abilities to pay. It implies that a person with higher income should pay more taxes than one with less income. Taxes may be proportional, progressive, or regressive. A proportional tax takes the same percentage of income from all people, either rich or poor. A progressive tax takes a higher percentage of income as income increases. Rich people do not only pay a higher amount of money than poor people, but a higher fraction of their income. A regressive tax takes a smaller percentage of income as income increases. Poor people pay a larger fraction of their income in taxes than the rich. B. Benefit principle. This states that only the beneficiaries of a particular government program should have to pay for it. The practical application of this principle is limited because most government services are consumed by the community as a whole. For instance, national defense. One cannot therefore estimate the benefit received by a particular individual in the community. Efficiency principle. A good tax system should be efficient, wasting as little money and resources as possible. No tax system is perfectly efficient, but government should strive to minimize the cost incurred in collecting taxes. The impact and incidence of tax. Impact of tax is its first contact with taxpayers. Impact of tax is the individual or corporate body that bears the first burden of paying tax to the authorities, which are those who are legally responsible for the payment of tax to the government. Incidence of tax is the individual or firm who finally bears the burden of a tax and who are not able to pass it to others. It is the final source from which tax money comes. There are some situations where a large proportion of tax burden of a tax is borne by the producer of the commodity, or the burden may be shared equally with the consumer. In some instances, the producer may bear smaller percentage of the tax burden and consumer bears larger percentage in form of higher prices. Even at times, the consumer bears the entire burden of the tax, or producers bear the whole burden of the tax. Elastic demand. This is when a little percentage change in price brings about a greater percentage change in quantity demanded of such commodity. From the graph above, if a tax is imposed on a commodity which is elastic in demand, the tax burden is shared between the consumer and producer. The producer bears a higher proportion of the tax burden in order to retain its customer because such goods have close substitutes, e.g. cars. Number 2, inelastic demand. These occurs when a percentage change in price brings about a lesser percentage change in quantity demanded. If a tax is imposed on goods which is inelastic in demand, the tax burden is shared between the producer and the consumer. The consumer bears a greater percentage of the tax burden, while producer bears a smaller percentage of the tax burden. This is because such commodities do not have close substitute. Even if the consumer reduces the quantity consumed, the consumer still bears greater percentage of the tax burden. Examples of such commodities are salt and cigarettes. 3. Perfectly inelastic demand. A good is perfectly inelastic in demand if a given percentage change in price brings about no change in quantity demanded. If a tax is imposed on such commodities, the consumer bears the entire burden of the tax, because such commodity is a necessity and consumers cannot do without its consumption on a regular basis. The consumer is ready to pay any price inasmuch as the required quantity is available. 4. Perfectly elastic demand. This is when a consumer is ready to buy all that is available at given price and none at all at a slightly higher price. The producer bears the entire burden of the tax when the demand for a commodity is perfectly elastic and tax is levied on it. The introduction of tax does not have any effect on the consumer. Tax evasion, tax avoidance, and tax base. Tax evasion. Tax evasion is a deliberate attempt by individuals or corporate bodies failing to pay legally due taxes. One important way that high tax rate affects people is by increasing tax evasion. People may not reveal their true income to the government, thus reducing the government's tax revenue. Tax avoidance. It is a deliberate attempt by individuals, corporate organizations, who take advantage of loopholes in tax laws to reduce the amount of taxes to be paid. One of the most serious problems of taxation is tax evasion and avoidance. This attitude could be in form of non-declaring the actual profit or income earned by corporate businesses or individuals. Tax base. The tax base is the legal description of the object on which tax is payable or calculated. For example, the base of income tax is the income of the taxpayer. Property is the base for property tax, and so on. It must be noted that A. The base of each tax has to be defined legally. B. It is to be quantified for the purpose of determining the tax liability of an individual taxpayer. C. An individual legal entity may be subjected to more than one tax. Summary. From the foregoing, it is seen that a tax is a compulsory levy imposed on individuals, corporate bodies, goods, and services. Taxes serve as source of revenue to the government. Government also uses tax to redistribute income in an economy. It also serves as a tool to maintain stability in an economy. Also, in this session, you learn the characteristics that a good tax system must possess, which include equality, certainty, convenience, economic fairness, and so on. The principle of fairness is based on two principles to determine whether the burden of tax is distributed fairly. These are ability to pay principle and benefit principle. Horizontal equity and vertical equity are the two requirements of ability to pay principle. Furthermore, you learn that indirect taxes are easy to collect and offer greater revenue. By their selective measure, they can help to allocate resources less harmful in terms of incentives in comparison to direct taxes, and as a result, they are more tolerated. Direct taxes, on the other hand, are economical and a powerful tool in the hands of government to curb inflationary pressure in the economy. This is the end of study session 6. Thanks for listening.